Did you know that tax errors are more common than you might think? Many taxpayers make avoidable mistakes, leading to penalties and missed opportunities for savings. From forgetting to file on time to claiming incorrect deductions, these blunders can have significant financial consequences. One of the most common tax myths is that only high-income earners need to worry about complex tax situations. However, the reality is that tax laws and regulations apply to everyone, regardless of income level. Understanding the basics of tax filing, such as filing status, deductions, and credits, is crucial for all taxpayers. By understanding common tax mistakes and how to avoid them, you can approach tax season confidently and keep more of your hard-earned money. One of the most common and costly tax mistakes is missing tax deadlines. Filing your tax return or requesting an extension by the deadline is crucial to avoid penalties. The penalty for failing to file on time can be as high as 25% of the unpaid taxes, depending on the length of the delay. Procrastination often stems from a fear of the unknown or feeling overwhelmed by tax forms and regulations. However, delaying filing only compounds the problem and increases the risk of errors. The sooner you begin gathering your tax documents and familiarizing yourself with the process, the less daunting it will seem. Consider using a tax calendar to keep track of important dates, such as filing deadlines, estimated tax payments, and extension requests. Start early, seek help when needed, and enjoy the peace of mind that comes with meeting your tax obligations. Proper record keeping is essential for maximizing deductions and minimizing tax liability. Failing to keep accurate records of income and expenses can lead to missed deductions and potential problems with the IRS. One of the most common record-keeping mistakes is failing to keep receipts. Receipts serve as proof of purchase and are crucial for substantiating deductions. Without receipts, it can be challenging to verify the amount, date, and purpose of an expense, making it difficult to claim the deduction. To avoid losing valuable deductions, develop a system for organizing and storing your receipts. Consider using a dedicated folder, envelope, or digital app to keep your receipts together and easily accessible. By keeping accurate and organized records, you'll be prepared to substantiate your claims and avoid potential issues. Choosing the correct filing status is crucial for determining your tax liability, standard deduction amount, and eligibility for specific credits and deductions. Mistakes in selecting the appropriate filing status can result in overpaying or underpaying taxes. The most common filing statuses are single, married filing jointly, married filing separately, head of household, and qualifying widow with dependent child. Each status has specific requirements based on marital status, dependents, and living arrangements. Your filing status can significantly impact your tax liability, so choosing the one that allows you to pay the least amount of taxes legally is essential. For example, married couples often benefit from filing jointly, as it typically results in a lower tax liability than filing separately. Review your eligibility for each filing status carefully and choose the one that best fits your circumstances. If you are unsure which status to choose, consult with a tax professional. Homeownership comes with various tax implications, including potential deductions and credits that can save you money. Understanding these tax breaks is crucial for maximizing your savings and minimizing your tax liability. One of the most significant tax advantages of homeownership is the mortgage interest deduction. This deduction allows you to deduct the interest paid on your mortgage, which can result in substantial savings, especially in the early years of your mortgage, when interest payments are typically higher. Another valuable deduction for homeowners is the property tax deduction. You can deduct property taxes paid on your primary residence, which can help offset the overall cost of homeownership. Additionally, you may be eligible for other deductions related to homeownership, such as deductions for mortgage points, real estate taxes, and insurance premiums. The IRS website and other reputable sources provide up-to-date information on tax breaks for homeowners. Freelancers and self-employed individuals face unique tax challenges compared to traditional employees. Understanding these challenges and how to navigate them is crucial for avoiding common mistakes and ensuring compliance with tax laws. One of the most common mistakes freelancers make is failing to pay estimated taxes. Unlike traditional employees who have taxes withheld from their paychecks, freelancers are responsible for paying their taxes throughout the year. Failure to do so can result in penalties and interest charges. The IRS requires estimated tax payments quarterly if you expect to owe at least $1,000 in taxes. Freelancers must also be aware of self-employment taxes. These taxes are typically higher than what traditional employees pay because self-employed individuals are responsible for both the employee and employer portions. Tax deductions are a valuable tool for reducing your tax liability and keeping more of your hard-earned money. By understanding the various deductions available, you can maximize your tax savings and optimize your financial situation. Above-the-line deductions, also known as adjustments to income, are deductions you can take even if you don't itemize. These deductions are taken directly from your gross income, reducing your adjusted gross income, AGI. Some common above-the-line deductions include contributions to traditional IRAs, student loan interest deductions, and health savings account, HSA, contributions. Itemized deductions are expenses you can deduct if they exceed the standard deduction for your filing status. Some common itemized deductions include medical expenses, state and local taxes, charitable contributions, and mortgage interest. Consulting with a tax professional can help you identify all applicable deductions and maximize your tax savings. While no one wants to receive an audit notice from the IRS, understanding the audit process and how to prepare can alleviate some anxiety and increase your chances of a favorable outcome. An audit is a review of your tax return by the IRS to ensure you have reported your income and deductions accurately and paid the correct amount of taxes. The IRS selects tax returns for audit based on various factors, including computer scoring, information matching, and random selection. If you are selected for an audit, the IRS will typically notify you by mail. The notice will specify the tax year under audit, the type of audit, and the documents you need to provide. There are three main types of audits: correspondence audits, office audits, and field audits. If you are selected for an audit, it's crucial to respond promptly to the IRS's notice and gather all requested documentation. If you are unsure how to proceed or feel overwhelmed, consider seeking professional assistance from a tax attorney or enrolled agent. Navigating the complexities of the tax code can be challenging, even for those familiar with basic tax principles. Seeking professional tax advice can provide valuable insights, ensure compliance with tax laws, and potentially save you money. Tax professionals, such as certified public accountants, CPAs, enrolled agents, EAS, and tax attorneys, possess specialized knowledge and expertise in tax matters. One of the primary benefits of professional tax advice is the assurance that your tax return is prepared accurately and in compliance with current tax laws. Tax professionals stay abreast of the latest changes in tax legislation and regulations, ensuring that your return reflects the most up-to-date information. This can help you avoid costly mistakes and potential issues with the IRS. When choosing a tax professional, it's essential to consider their qualifications, experience, and areas of expertise. Ensure they are licensed and insured to provide tax services. Tax software has revolutionized the way people file their taxes, offering a convenient, affordable, and user-friendly alternative to traditional pen and paper methods. With a wide range of tax software options available, choosing the one that best suits your needs and financial situation is essential. Consider factors such as cost, features, and ease of use when making your decision. Some popular tax software options include TurboTax, H&R Block, and TaxAct. These software programs guide you through the tax filing process step by step, prompting you for necessary information and performing calculations automatically. When choosing tax software, consider your tax situation's complexity. If you have a relatively simple tax return, a basic software package may suffice. However, if you have a more complex tax situation, such as self-employment income, investment income, or rental property income, you may need a more comprehensive software package. Tax season doesn't have to be a time of dread and confusion. By understanding common tax mistakes and implementing the tips outlined in this essay, you can approach tax filing confidently and keep more of your hard-earned money. Start by developing a system for organizing your tax documents throughout the year. Keep track of income, expenses, deductions, and credits. Consider using a spreadsheet, a tax software program, or a professional organizer to stay on top of your finances. The more organized you are, the smoother your tax filing process will be. Don't be afraid to ask for help when you need it. If you have a more complex tax situation, consider consulting with a tax professional. Take control of your taxes today and set yourself up for financial success.